Hey everyone, welcome back to the channel. Today we're diving into something that could completely transform your investment strategy. Building the perfect 3 ETF portfolio using VOO, SCHD, and JEPI that can weather any market condition. We'll analyze exactly how these ETFs performed during every major market crash from the 2008 financial crisis to the COVID-19 pandemic and even the April 2025 correction, with real recovery timelines that might surprise you. Imagine having a portfolio that delivers growth when markets are booming, protection when they're crashing, and consistent income throughout it all. Sounds too good to be true? Well, stick around because by the end of this video, I'll show you exactly how Harry's $10,000 investment in this balanced approach could potentially grow to over $1 million while paying thousands in monthly dividends. Plus, I'll reveal a simple monthly investment plan that anyone can follow to build their own $1 million dividend portfolio. Why these 3 ETFs? Let's face it, investing isn't just about choosing one winning stock or ETF. The market is unpredictable, and what works in a bull market often fails spectacularly during corrections. Looking at the actual performance data from April 2025, we can see dramatic differences in how these ETFs have performed recently. JEPI is down 8.94% over the past year with a one-day drop of 5.56% on April 2nd. SCHD is down 5.20% over the past year with a one-day drop of 5.42% on April 2nd. VOO is down 3.26% over the past year with a one-day drop of 5.80% on April 2nd. These different responses to market conditions show why a balanced approach makes sense. Each of these ETFs serves a specific purpose in a portfolio, and together they create something greater than the sum of their parts. VOO analysis. Let's start with VOO, the Vanguard S&P 500 ETF. According to the latest data as of April 2nd, 2025, assets under management, $598.65 billion. Expense ratio, a rock-bottom 0.03%. Dividend yield, 1.41%. Annual fund flows, $128.21 billion. VOO's sector breakdown shows it's heavily weighted toward technology, electronic technology, 21.66%, technology services, 19.51%, finance, 14.46%, health technology, 8.56%. The top holdings reflect this tech concentration. Apple, 7.24%, Nvidia, 6.07%, Microsoft, 5.85%, Amazon, 3.93%, Meta Platforms, 2.88%. VOO's performance has been impressive over the long term, with an all-time return of 354.17%, but it's currently experiencing a challenging period with one-day performance, negative 5.80%. One-month performance, negative 12.21%. Year-to-date, negative 14.11%. The data shows VOO has a strong growth track record over 5 years, 102.02%, but it can experience significant volatility during market downturns. SCHD analysis. Now let's examine SCHD, the Schwab U.S. Dividend Equity ETF. The latest data shows assets under management, $70.88 billion. Expense ratio, 0.06%. Dividend yield, 3.89%. Annual fund flows, $12.39 billion. SCHD's sector allocation is significantly different from VOO. Consumer non-durables, 17.06%. Health technology, 15.84%. Energy minerals, 14.82%. Electronic technology, 11.49%. Finance, 8.19%. The top holdings include ConocoPhillips, 4.44%, Verizon Communications, 4.41%, Coca-Cola Company, 4.32%, Chevron Corporation, 4.29%, PepsiCo, 4.07%. SCHD's performance shows better downside protection than VOO in recent months. One-day performance, negative 5.42%, slightly better than VOO's negative 5.80%. One-month performance, negative 9.23%, better than VOO's negative 12.21%. Year-to-date, negative 7.97%. Significantly better than VOO's negative 14.11%. The fund has a strong long-term track record with an all-time return of 203.36% and impressive 5-year performance of 70.08%. JEPI analysis. Our third ETF is JEPI, the JPMorgan Equity Premium Income ETF. The latest data shows assets under management $38.34 billion, expense ratio 0.35%, dividend yield a substantial 7.84%, annual fund flows $6.38 billion. JEPI's sector allocation is well-balanced: finance 16.00%, health technology 13.09%, electronic technology 12.34%, technology services 10.98%, consumer non-durables 8.68%. Top holdings include Progressive Corporation 2.05%, Visa Inc. 1.95%, MasterCard 1.93%, AbbVie 1.90%, Southern Company 1.84%. JEPI's recent performance has been challenging but with less volatility in the long term. One-day performance, negative 5.56%. One-month performance, negative 10.10%. Year-to-date, negative 9.87%. 1 year, negative 8.94%. Despite recent market turbulence, JEPI still has a positive all-time return of 4.22%, which is modest compared to the other ETFs, but impressive considering its income-focused strategy and shorter history. Historical crash performance data. Let's look at actual data from past market crashes to understand how these ETFs typically perform. COVID-19 crash, Feb to Mar, 2020. VOO fell 35.0% with a 5-month recovery time. SCHD declined 37.7% with a 13-month recovery time. JEPI was launched during this period, so no data is available. 2022 growth stock. Correction. VOO declined 25.7% with a 15-month recovery period. SCHD dropped only 16.2% with a 7-month recovery period. JEPI declined just 14.2% with an 8-month recovery period. April 2025. Market turbulence, ongoing. VOO has dropped 14.11% year-to-date. SCHD has declined 7.97% year-to-date, showing better resilience. JEPI has fallen 9.87% year-to-date, with higher income offsetting some losses. This data clearly shows how SCHD and JEPI typically provide better downside protection during market corrections, while VOO tends to drop more sharply but often recovers with stronger growth afterward. Performance in different market environments. Using the historical data, we can identify how each ETF performs in different market environments. During bull markets, VOO leads with the strongest performance, 102.02% over 5 years. SCHD follows with solid performance, 70.08% over 5 years. JEPI provides more modest capital appreciation but higher income. During bear markets, JEPI shows the best relative performance, smallest drawdowns in 2022. SCHD demonstrates better downside protection than VOO. VOO typically experiences the largest declines. During recovery periods, VOO often leads with the strongest percentage rebounds. SCHD recovers gradually with less volatility. JEPI tends to lag in sharp recoveries but provides consistent income. The current year-to-date performance perfectly illustrates these patterns. VOO down 14.11%, SCHD down 7.97%, and JEPI down 9.87%. Building the ideal portfolio. Based on this actual performance data, let's design 3 model portfolios tailored to different investment stages. Growth portfolio, 20s to 40s. 60% VOO for maximum growth potential. 30% SCHD for dividend growth and moderate income. 10% JEPI for higher immediate income and downside protection. Balanced portfolio, 40s to 50s. 40% VOO for continued growth. 40% SCHD for balanced growth and income. 20% JEPI for increased income and greater stability. Income Portfolio, 60 plus or retirement. 20% VOO to maintain some growth. 30% SCHD for dividend growth. 50% JEPI for maximum current income and capital preservation. Using actual yield data, here's what a $10,000 investment would generate in annual income right now. For the growth portfolio, VOO, 60%. $6,000 x 1.41%, $84.60. SCHD, 30%. $3,000 x 3.89%, $116.70. JEPI, 10%. $1,000 x 7.84%, $78.40. Total annual dividend income, $279.70, 2.79% yield. For the income portfolio, VOO, 20%, $2,000 x 1.41%, $28.20. SCHD, 30%, $3,000 x 3.89%, $116.70. JEPI, 50%, $5,000 x 7.84%, $392. Total annual dividend income, $536.90, 5.37% yield. This demonstrates how you can adjust your allocation to meet specific income needs while maintaining appropriate growth exposure. Growth projections based on historical data. Let's look at how Harry's $10,000 initial investment might grow over time in the balanced portfolio. 40% VOO, 40% SCHD, 20% JEPI, using actual historical performance as a guide. Based on the documented 5-year performance data, VOO, 102.02%, approximately 15.1% annually. SCHD, 70.08%, approximately 11.2% annually. JEPI, limited long-term data, but approximately 7% annually based on its strategy. After 10 years, VOO, 40%, $4,000, growing to approximately $16,300. SCHD, 40%, $4,000 growing to approximately $12,200. JEPI, 20%, $2,000 growing to approximately $3,900. Total portfolio value, $32,400. After 20 years, VOO, 40%, $4,000 growing to approximately $66,700. SCHD, 40%, $4,000 growing to approximately $37,400. JEPI, 20%, $2,000 growing to approximately $7,700. Total portfolio value, $111,800. After 30 years, with the power of compounding, VOO, 40%, $4,000 growing to approximately $273,000. SCHD, 40%, $4,000 growing to approximately $114,400. JEPI, 20%, $2,000, growing to approximately $15,000. Total portfolio value, $402,400. If Harry contributes an additional $500 monthly, $6,000 annually, with the same allocation strategy, after 30 years his portfolio could exceed $1.5 million based on these historical growth rates. With a $1.5 million portfolio following our balanced allocation, Harry's annual dividend income would be approximately VOO, 40%, $600,000 x 1.41%, $8,460. SCHD, 40%, $600,000 x 3.89%, $23,340. JEPI, 20%, $300,000, 7.84%, $23,520. Total annual dividend income, $55,320 or over $4,600 per month. This demonstrates the power of this 3 ETF strategy for both wealth building and income generation. Implementation strategy. To implement this strategy effectively, 1. Select the appropriate allocation model based on your age and goals. 2. Open a brokerage account with low trading fees. 3. Make your initial investments according to your chosen allocation. 4. Set up automatic contributions if possible. 5. Reinvest all dividends until you need the income. 6. Rebalance annually to maintain your target allocation. For tax efficiency, consider placing JEPI in tax-advantaged accounts like IRAs, since its distributions aren't qualified dividends. SCHD, which generally pays qualified dividends, can be more tax-efficient in taxable accounts. The data clearly shows that combining VOO, SCHD, and JEPI in a single portfolio creates a powerful investment strategy that can provide strong growth potential through VOO, 354.17% all-time return. Deliver growing dividend income through SCHD, 3.89%, yield with 11.2% annual growth. Generate high current income through JEPI, 7.84% yield. Offer better downside protection during market corrections, as shown in the 2022 and current drawdowns. We've seen exactly how these ETFs performed during the COVID crash, the 2022 correction, and the current market turbulence. The recovery patterns are clear. VOO drops harder but bounces back stronger. SCHD provides the perfect middle ground with moderate drawdowns and faster recovery times, and JEPI delivers that consistent income cushion during the worst market conditions. This 3 ETF approach gives you broad market exposure through VOO, quality dividend growth through SCHD, high current income and downside protection through JEPI. The actual performance data confirms that this strategy works, allowing you to build wealth while managing risk across all market conditions. Whether you're in your 20s just starting to invest or in your 60s looking for retirement income, this portfolio can be tailored to meet your needs. If you found this video helpful, please hit that like button and subscribe for more investing content. Let me know in the comments which of these 3 ETFs is your favorite and why. Thanks for watching, and I'll see you in the next video.